Question 1. An investor holding an American Depository Receipt, ADR, would typically be exposed to which of the following risks not directly associated with owning a domestic stock? A. Credit risk. B. Exchange rate risk. C. Reinvestment risk. D. Interest rate risk. Answer: B. Exchange rate risk. An American Depository Receipt, ADR, represents shares of a foreign company traded on U.S. exchanges, and their value is influenced by the performance of the underlying foreign stock and the prevailing exchange rate between the U.S. dollar and the foreign currency. Therefore, holding an ADR inherently exposes the investor to exchange rate risk, meaning that a weakening of the foreign currency relative to the U.S. dollar would diminish the value of the ADR, even if the underlying foreign stock price remains constant. Remember, ADRs are a convenient way to invest in foreign companies without direct foreign currency transactions, but the currency fluctuation still impacts your return. Question 2. A registered representative receives an unsolicited order from a customer to purchase a complex, illiquid product that the representative believes is unsuitable for the customer's stated investment objectives and risk tolerance. Which of the following actions is most appropriate for the registered representative? A. Refuse the order immediately without explanation. B. Execute the order but document that the trade was unsolicited and unsuitable. C. Explain the risks and unsuitability to the customer and recommend against the purchase. D. Seek approval from a principal to proceed with the order, disclosing the unsuitability. Answer: C. Explain the risks and unsuitability to the customer and recommend against the purchase. When a customer places an unsolicited order for a product deemed unsuitable, a registered representative's primary duty is to protect the customer's interests by explaining the risks involved and advising against the transaction. While firms may have policies allowing the execution of unsolicited, unsuitable orders with proper documentation, often called a not-held order where the firm executes but documents the customer's insistence, the most appropriate action is to ensure the customer is fully aware of the potential negative implications before any execution. Always prioritize educating and protecting your customers, even if it means advising against their wishes. Question 3. Under FINRA rules, which of the following activities by a registered representative requires prior written consent from their employing broker-dealer? A. Performing volunteer work for a local charity organization. B. Purchasing stock for a personal investment account. C. Accepting compensation for serving on the board of directors of a publicly traded company. D. Tutoring high school students for a fee on weekends. Answer: C. Accepting compensation for serving on the board of directors of a publicly traded company. Serving on the board of directors of a publicly traded company, especially for compensation, is considered outside business activity under FINRA rules and requires prior written notice to and approval from the employing broker-dealer. This is because such activities could present potential conflicts of interest, interfere with the representative's responsibilities to the firm, or create the appearance of endorsement by the firm. While other activities like personal investments or uncompensated volunteer work generally do not require prior consent, anything that involves compensation or a position of influence outside the firm's scope warrants disclosure and approval. When in doubt about an outside activity, it's always best to disclose it to your firm's compliance department. Question 4. An investor seeks a diversified portfolio that offers professional management and is traded on an exchange throughout the day, but wishes to avoid the premium or discount issues often associated with closed-end funds. Which of the following would be the most suitable recommendation? A. A mutual fund, open-end fund. B. An exchange-traded fund, EGF. C. A unit investment trust, UIT. D. A real estate investment trust, REIG. Answer: B. An exchange-traded fund, EGF. Exchange-traded funds, ETFs, offer professional management and diversification similar to mutual funds, but unlike mutual funds, they trade on exchanges throughout the day like individual stocks. Crucially, ETFs are typically priced very close to their net asset value, NAV, due to their creation and redemption mechanisms, which helps avoid the significant premiums or discounts that can affect closed-end funds. Mutual funds, open-end, trade only once a day at NAV. UITs are static portfolios and REITs are specific to real estate, not broad diversification. ETFs are a great solution for investors seeking intraday trading flexibility without the price deviation from NAV that closed-end funds can experience. Question 5. All of the following are typically considered investment companies, XEPT. A. An exchange-traded fund, ETF. B. A unit investment trust, UIT. C. A variable annuity. D. A closed-end fund. Answer: C. A variable annuity. Investment companies, as defined by the Investment Company Act of 1940, primarily include face amount certificate companies, unit investment trusts, UITs, and management companies, such as open-end funds like mutual funds and closed-end funds, which also include ETFs. A variable annuity, while containing an investment component, its subaccounts is classified as an insurance product regulated by state insurance departments, not primarily as an investment company under federal securities law. Remember, if it's an insurance product, even with an investment element, it typically falls under insurance regulation first. Question 6. A customer expresses concern about legislative risk. Which of the following investments is most susceptible to this type of risk? A. U.S. Treasury bonds. B. Money market mutual funds. C. Municipal bonds. D. Blue chip stocks. Answer: C. Municipal bonds. Legislative risk refers to the potential for changes in laws or regulations to negatively impact an investment's value. Municipal bonds are particularly susceptible to this risk because their primary attraction for many investors is their tax-exempt status, which is a feature of federal law. If Congress were to change the tax laws to eliminate or significantly reduce the tax exemption for municipal bond interest, the value of existing municipal bonds could drop significantly as their attractiveness diminishes. While all investments can be affected by legislation, the direct tax benefit of municipal bonds makes them uniquely vulnerable to changes in tax law. Question 7. Under the Securities Exchange Act of 1934, which of the following entities is primarily responsible for regulating the secondary market? A. Securities and Exchange Commission, SEC. B. Financial Industry Regulatory Authority, FINRA. C. Federal Reserve Board, FRB. D. Municipal Securities Rulemaking Board, MSRB. Answer: A. Securities and Exchange Commission, SEC. The Securities Exchange Act of 1934 created the Securities and Exchange Commission, SEC, and gave it broad authority over all aspects of the securities industry, including the registration and regulation of brokers, dealers, and exchanges, as well as the regulation of the secondary market. The trading of existing securities, while FINRA is an SRO that writes and enforces rules for broker-dealers, and the FRB sets margin requirements, the SEC is the ultimate federal regulator overseeing the entire securities market. The SEC's role is to protect investors and maintain fair, orderly, and efficient markets. Question 8. An investor is long 100 shares of ABC stock at $50 and writes one ABC Oct 55 call at $3. What is the investor's maximum potential gain on this covered call position? A. $300. B. $500. C. $800. D. Unlimited. Answer: C. $800. 55 at expiration. The gain from the stock is the difference between the strike price and the purchase price. $55.50 equals $5 per share, or 3 per share, or 500 plus $300. The maximum potential gain is $800. The call option effectively caps the stock's appreciation at the strike price, but the premium received increases the overall profit potential. Question 9. Which type of order guarantees execution at a specific price or better, but not execution itself? A. Market order. B. Limit order. C. Stop order. D. Stop limit order. Answer: B. Limit order. A limit order is an order to buy or sell a security at a specific price or better. For a buy limit order, it will execute at the limit price or lower. For a sell limit order, it will execute at the limit price or higher. The key feature is that while it guarantees the price, if executed, it does not guarantee execution. If the market price never reaches or passes the specified limit price, the order will not be filled. Think of a limit order as setting your preferred price, but if the market isn't willing to meet it, your trade won't happen. Question 10. A private placement offering is exempt from the registration requirements of the Securities Act of 1933 primarily because it is offered to A. A limited number of institutional investors. B. Investors who are considered accredited or sophisticated. C. Individuals who reside in the same state as the issuer. D. The general public without any solicitations. Answer: B. Investors who are considered accredited or sophisticated. Private placements, often done under Regulation D, are exempt from the extensive registration requirements of the Securities Act of 1933 because they are offered only to a limited number of investors who are deemed to be accredited, meeting certain income or net worth thresholds, or sophisticated, having sufficient knowledge and experience to evaluate the risks of the investment. The rationale is that these investors are considered capable of fending for themselves and do not require the same protections as the general public provided by SEC registration. Remember, the focus is on the investor's ability to understand and bear the risk, not just their type or location. Question 11. Which of the following is typically a characteristic of an exchange-traded note, ETN? A. It represents an ownership interest in a pool of securities. B. It provides direct exposure to a specific commodity or index without holding the underlying asset. C. It is a debt instrument backed by the creditworthiness of the issuing bank. D. It pays a variable interest rate based on market conditions. Answer: C. It is a debt instrument backed by the creditworthiness of the issuing bank. An exchange-traded note, ETN, is a type of unsecured, unsubordinated debt security that tracks an underlying market index or strategy. Unlike ETFs, ETNs do not hold any underlying assets. Instead, they are promises by the issuing bank to pay the return of a particular index, minus fees. This means that an ETN's performance depends not only on the performance of the underlying index, but also on the creditworthiness of the issuing bank, introducing an element of credit risk. Think of an ETN as a bank's promise to pay you the return of an index, meaning you're exposed to the bank's financial health. Question 12. Which of the following types of investment accounts offers the most flexible contribution limits and is generally subject to taxation of qualified distributions as ordinary income? A. Roth IRA. B. Traditional IRA. C. 529 Plan. D. Coverdell Education Savings Account, ESA. Answer: B. Traditional IRA. A traditional IRA generally offers the most flexible contribution limits among the options listed, allowing individuals to contribute a set amount annually, which can change, and often deduct those contributions, leading to tax-deferred growth. However, qualified distributions from a traditional IRA at retirement are taxed as ordinary income, Roth IRAs have income limitations for contributions, and 529 plans and Coverdell ESAs are specific education savings vehicles with different contribution and distribution rules. When considering an IRA, remember traditional IRAs are about tax deferral now and taxation later, while Roth IRAs are about tax-free withdrawals later. Question 13. Which of the following economic indicators would generally lead the economy? A. Unemployment rate. B. Corporate profits. C. Housing starts. D. Manufacturing new orders. Answer: C. Housing starts. Leading economic indicators are those that tend to change before the economy as a whole changes, providing a glimpse into future economic activity. Housing starts, the number of new residential construction projects begun, are considered a leading indicator because an increase or decrease in new housing construction often precedes broader changes in consumer spending and economic growth. Unemployment rates and corporate profits are generally lagging indicators, reflecting past economic performance, while manufacturing new orders can be a leading or coincident indicator depending on the context. Keep in mind that leading indicators are like a crystal ball for the economy, hinting at what's to come. Question 14. A broker-dealer must verify the identity of a new customer opening an account. This requirement is mandated by which of the following? A. Securities Act of 1933. B. Investment Company Act of 1940. C. USA Patriot Act. D. Sarbanes-Oxley Act. Answer: C. USA Patriot Act. The USA Patriot Act, enacted in response to the 9/11 attacks, requires financial institutions, including broker-dealers, to establish customer identification programs, CIPs, to verify the identity of new customers. This is a crucial anti-money laundering (AML) measure designed to prevent the financing of terrorism and other illicit activities. While other acts regulate different aspects of securities, the USA Patriot Act is specifically focused on identity verification for national security purposes. Remember, the Patriot Act is all about knowing your customer to prevent financial crimes. Question 15. A customer opens a cash account and immediately purchases 100 shares of XYZ stock for $50 per share. 3 business days later, on settlement date, the customer has not paid for the trade. Which of the following actions is the broker-dealer required to take? A. Sell out the shares and freeze the account for 90 days. B. Liquidate the shares and issue a margin call. C. Extend the settlement date for an additional 2 business days. D. Report the customer to FINRA for non-payment. Answer: A. Sell out the shares and freeze the account for 90 days. If a customer in a cash account fails to pay for a purchase by the settlement date, T+2 business days for equities, the broker-dealer is required to sell out the securities purchased. Additionally, the account will be frozen for 90 calendar days, meaning the customer can only make cash purchases. Funds must be in the account prior to placing a buy order. For that period, this is at FINRA rule, specifically under Regulation T for extensions and sellouts, to prevent free riding, where an investor tries to profit from a price increase without using their own capital. Question 16. Which of the following statements about the taxation of municipal bonds is generally true? A. Interest income is always tax-exempt at the federal level. B. Capital gains are tax-exempt at the federal level. C. Interest income is always tax-exempt at the state and local levels. D. Interest income may be triple tax-exempt if the investor is a resident of the issuing state. Answer: D. Interest income may be triple tax-exempt if the investor is a resident of the issuing state. While interest income from municipal bonds is generally exempt from federal income tax, it is typically only exempt from state and local taxes if the investor is a resident of the issuing state or territory. known as triple tax exempt. This means that if you live in New York and buy a New York municipal bond, the interest is likely free from federal New York State and New York City taxes. Capital gains, however, are taxable regardless of the issuer. Always remember that municipal bonds offer a tax advantage on interest, but the extent of that advantage depends on your residency. Question 17. All of the following are considered types of communications with the public requiring principal approval by an FINRA member firm (CPD). A. Correspondence sent to a single retail customer. B. Retail communication available to more than 25 retail customers within 30 calendar days. C. Institutional communication sent only to institutional investors. D. A public appearance by a registered representative. Answer: C. Institutional communication sent only to institutional investors. FINRA rules categorize communications based on their audience and content, and the level of principal approval required varies. Institutional communications, defined as written communications distributed only to institutional investors, like banks, insurance companies, or investment advisors, generally do not require prior principal approval. This is because institutional investors are presumed to be sophisticated and capable of understanding the information without as much regulatory oversight. However, retail communications, more than 25 retail customers, and public appearances always require prior principal approval, and correspondence, 25 or fewer retail customers, requires supervision and review. Question 18. A customer holds a portfolio heavily concentrated in the common stock of a single company. This concentration exposes the customer primarily to which of the following risks? A. Interest rate risk. B. Diversification risk. C. Liquidity risk. D. Business specific risk. Answer: D. Business specific risk. When a portfolio is heavily concentrated in the common stock of a single company, the investor is primarily exposed to business risk, also known as specific risk or unsystematic risk. This is the risk that the particular company will perform poorly due to factors unique to its industry, management, or product line, causing a significant loss to the investor's portfolio. Diversification, the opposite of concentration, is specifically designed to mitigate this type of risk by spreading investments across various companies and industries. Remember, putting all your eggs in one basket makes you highly vulnerable to that one basket breaking. Question 19. A registered representative receives an email from a customer requesting to change their address on file. What is the most appropriate action for the registered representative to take? A. Immediately update the customer's address as requested via email. B. Forward the email to a principal for review and approval. C. Instruct the customer to submit the address change in writing, signed by the customer. D. Call the customer to verbally confirm the address change, then update the record. Answer: C. Instruct the customer to submit the address change in writing, signed by the customer. For security and compliance purposes, significant customer account changes, such as an address change, typically require the customer's written authorization and signature to prevent fraud or unauthorized changes. Relying solely on an email or a verbal confirmation is not sufficient, as it lacks proper verification. Firms generally require a signed form or a process that confirms the customer's identity and intent beyond reasonable doubt. Always remember to prioritize security and follow firm procedures for sensitive customer information updates. Question 20. Which of the following describes the type of account where a financial institution, such as a bank, holds assets on behalf of a minor, with a custodian designated to manage the account until the minor reaches the age of majority? A. Joint tenants with right of survivorship, JTWRS. B. Tenancy in common, TIC. C. Uniform Gifts to Minors Act, UGMA. / Uniform Transfers to Minors Act, UTMA. D. revocable trust account? Answer C. Uniform Gifts to Minors Act, UGMA. / Uniform Transfers to Minors Act, UTMA. Uniform Gifts to Minors Act, UGMA. And Uniform Transfers to Minors Act, UTMA. Accounts are special custodial accounts created for minors. Under these accounts, a custodian, often a parent or guardian, is appointed to manage the assets until the minor reaches the age of majority, typically 18 or 21, depending on state law. While the custodian manages the account, the assets legally belong to the minor, and once the minor reaches the age of majority, they gain full control. These accounts are a common way for adults to give gifts or transfer assets to minors. Question 21. Under what circumstances would a registered representative be permitted to share in the profits and losses of a customer's account? A. Only if the customer is a family member. B. Only if the representative contributes capital and shares proportionately and the firm approves. C. If the representative is the customer's financial advisor, regardless of capital contribution. D. Under no circumstances, as it is always prohibited. Answer B. Only if the representative contributes capital and shares proportionately and the firm approves. FINRA Rule 2150, formerly Rule 2150, permits a registered representative to share in the profits or losses of a customer's account only if two conditions are met. The registered representative contributes capital to the account, i.e., invests money in the account, and the sharing of profits and losses is proportionate to the representative's capital contribution. Additionally, the broker-dealer must provide written approval for such an arrangement. Sharing in the profits or losses without capital contribution, example, just sharing based on advice, is strictly prohibited. This rule ensures that representatives have skin in the game when sharing, aligning their interests with the customers. Question 22. A company is issuing new common stock to the public for the first time. This offering would be best described as a N. A. Secondary offering. B. Initial public offering, IPO. C. Shelf registration. D. Follow-on offering. Answer B. Initial public offering, IPO. An initial public offering, IPO, occurs when a private company first offers its shares to the general public, effectively going public. This is the first time the company's stock is available for purchase by individual investors and institutions in the primary market. A secondary offering involves existing shares. A shelf registration allows for future offerings over time, and a follow-on offering is a subsequent public offering by a company that is already public. Remember, initial means first, so an IPO is the very first time a company offers its shares to the public. Question 23. A bond's yield to maturity, YTM, is higher than its coupon rate. This indicates the bond is currently trading at A. Premium. B. Discount. C. Par value. D. Variable rate. Answer B. Discount. When a bond's yield to maturity, YTM, is higher than its coupon rate, it means that the bond's current market price is less than its par value. It is trading at a discount. Investors buying the bond at a discount will receive capital appreciation, the difference between the discount price and par value at maturity, in addition to the coupon payments, which effectively increases their overall return, yield above the stated coupon rate. Conversely, if YTM is lower than the coupon, the bond is trading at a premium. The relationship between yield and price is inverse. When market yields rise above a bond's coupon, its price must fall to make its yield competitive. Question 24. An investor executes a short sale of 100 shares of XYZ stock. Which of the following is the primary risk associated with this position? A. The stock price declines significantly. B. The investor may be obligated to buy back shares at a higher price if the stock rises. C. The investor loses the dividend payments. D. The investor's interest income on the proceeds is insufficient. Answer B. The investor may be obligated to buy back shares at a higher price if the stock rises. A short sale involves borrowing shares and selling them, hoping to buy them back later at a lower price to return to the lender. The primary risk of a short sale is unlimited upside risk, meaning if the stock price rises significantly, the investor faces potentially unlimited losses because there is no CAP on how high the stock price can go before they must cover their position by buying back shares. The goal of a short seller is for the stock to fall, but the risk is exactly the opposite happening. Remember, for a short sale, your maximum gain is limited to the stock falling to $0, but your maximum loss is theoretically unlimited. Question 25. A customer holds a variable annuity and is concerned about the impact of inflation on the purchasing power of their future income payments. Which of the following annuity payout options would best address this concern? A. A fixed annuity payout option. B. A lump sum distribution. C. An increasing annuity payout option. D. A reduced payout for a longer period. Answer C. An increasing annuity payout option. An increasing annuity payout option is designed to help mitigate the risk of inflation by providing payments that grow over time. While a variable annuity's payout already fluctuates based on the performance of the underlying separate account, an increasing payout option specifically adjusts the payment upward, often on a predetermined schedule or tied to an index, to help maintain purchasing power against rising living costs. Fixed annuities offer stable payments but lose purchasing power to inflation, while lump sums don't address ongoing income needs, and reduced payouts for longer periods don't specifically combat inflation. If you're worried about inflation eating away at your future income, an increasing payout option is a good way to fight back.